Hi Swagat, I have some few doubts. Can you help me with that?
Hey, hi Tarun, how are you?
Okay, my first question is, will my senior citizen parents get health insurance at this age? And second one is, I have a room rent capping in my policy up to a certain amount. Is it good or bad? And third, I have a few endowment plans and ULIP policies. Am I covered sufficiently? And one more question.
No, hold on. I know you have a lot of questions and I'll be happy to answer, but not here. Attend the webinar on Saturday, Common Questions and Uncommon Answers, where you will be asking some common questions and I'll be answering the uncommon way. Don't miss it.
No place to hide. That's the topic of today's video. Investors, especially professional investors, always seek safe havens where they can park capital because they keep collecting capital at the wrong end of the cycle. It's important for them to park that money in a safe place where they stand low chance of a sharp erosion if the market corrects. Everybody knows that the threat of a market correction is real. Every professional manager is fully aware of this. But money is coming and they think that their clients would want them to invest it immediately into equity. The compulsion to invest the money immediately into equity forces them to seek out safe havens. Historically, these safe havens have been IT, FMCG, private banking and pharma in that order. Over a period of time, fund managers have tried to extend this list and try to include other sectors like FMIG, some platforms, other consumption themes, footwear, paints, and the list runs quite long. So fund managers have been accustomed to searching for safe havens because these safe havens help them to conveniently deploy capital with the expectation that they won't lose money if the market falls sharply. That's all there is to this. But as luck would have it, from the bottom of 2018, these stocks performed admirably. Money which you put in a safe haven became an outlier by the time COVID came because everybody was rushing towards safe havens in the early days of the COVID trade, and this rush to safety elevated the valuations of these defensive stocks sharply. That's when you started talking of this as a fail-safe investment philosophy where you can buy at any price. So when this safe haven investing worked so well, the temptation to turn it into a fail-safe investment philosophy that delivers returns was too much, both for those who were trying to create that story and to the listeners, and it was lapped up. Cut to December 23, the situation was not looking good. Inflation spoiled this whole trade. If you ask me what was the spoiler in this whole trade, I would think it's inflation. And inflation in a geography which has never seen inflation in a long time to come, the United States of America, completely decimated this trade. But in the Indian stock market, we did not derate most of these companies. Even after the results of Q4, several of these defensive stocks are still kind of struggling to hold on to their elevated valuations. There is no hurry to derate these stocks. But if you are a student of investing for a very long period of time, you know that it will come someday because inflation is not going to soften the way the market wants it to, and demand is definitely not supporting these industries to pass on any increase in cost so easily. So they are doing all the usual tricks, changing the size packs, changing the price points, all those things. But all these can take you only that far. As far as IT is concerned, in one calendar year, IT has moved from a growth story to a stagnation story. But the real shocker is in private banks. The merger of HDFC and HDFC Bank is probably taking longer to digest, and only after the merger is completely synthesized, you can see growth come back and profit growth visibility reappear. As far as the other top private banks are concerned, firstly, they have not been able to promise much, and secondly, their delivery has also not been so great. The only exception being ICICI Bank. Now, with more money chasing other asset classes, capital, which is the main raw material of a bank, is becoming pricier for private banks. It's not easy anymore. I see my private bankers allow me to keep my surplus liquidity even in a current account in a FD, which is an auto shift mechanism. So money never idles in the current account, which means that they are not going to get this money in CASA. And more people are going to make it tougher for these private banks to access cheap capital. And the confidence of the public banks in lending is something which was absent for a very long time, especially between 2018 and 2021. But now public banks are competing. They are more confident. Their share of retail loans is increasing continuously, which means that the most profitable part of private banks business, which is retail lending, is now a very crowded trade. Public banks are very much there in the trade. So even there, we are not seeing the kind of strength or confidence even amongst the bankers to guide strongly. Naturally, as investors, our confidence is also going to gradually derate. So this whole defensive trade seems to be coming apart, and the only place where I can see it somewhat showing a modicum of respect is in pharma. But to be fair, pharma assets were not so expensive for a very long time to come. So we are seeing fewer and fewer safe havens, rising difficulty to hide, fewer opportunities where you can put money like a hiding spot, and every section of the defensive trade becoming more vulnerable. And in my opinion, this is just the beginning. In the next few quarters, it could turn worse unless inflation comes down very sharply and demand revives. But I suspect that even that will happen more towards the beginning of the next calendar year, and these 3 quarters are going to be tough for the defensive trade and for all companies which are in defensive businesses. So professional managers have no place to hide, and this in turn is going to also make them impatient, because if they are not performing well against the benchmark, they would rather take the money to some other place where there is some scope of an upside. Because having invested in a defensive trade where you thought there was no downside, when you see the downside in front of you, you don't want it. You first want to walk out. So this is something that I expect professional managers to do if they haven't already begun, and this in turn is going to put a lot of stress on defensive businesses. I'm not sure the retail investor is ready for this, but it will be very interesting to see how he responds when the professional manager is on the sell side. So far, they've both been on the same side. Now they're taking opposite sides. And retail is cooled on this theory that they can buy defensive stocks at any time and nothing bad will happen. Probably there is some element of truth to that, but if you don't have reasonable upside over the long term and you're only going to go down and come back to where you started, that's not a good way to invest. And that's not something that will give retail investors any comfort. So I expect the retail investor also to show impatience and move his capital away from the defensive trade. This is a market where it's difficult even to be a defensive investor. And that tells you what you must do now, which is seek out higher safety. Being just a defensive investor in defensive sectors won't do. You need to be far more defensive and move your money into a safer asset class before you come back into equity where you find value and growth. Thank you for watching this video.